Welcome all to the Node. I am Mike, aka Veteran Crypto, and this is your place for news, interviews, and DeFi and crypto education. So, with that, we're going to jump right into it. Morning, Crispy, morning, crew. And if you could, on your way in, be sure to smash the like, help us spread the word. We are trying to be a channel that is different from all the others. We don't hype here. We focus strictly on the facts, on the data. We present the bullish and bearish on every project, even the ones that we're most bullish on. We're not here to influence you to invest in any way, to buy or sell. We are simply here to educate you, give you the basics, and from there, if the project sounds interesting to you, you can do your own research, dig deeper, and decide if you want to invest in it or not. It affects us in no way whatsoever what you choose to buy or sell. So with that, I'm going to jump right into it. But let's do this while we're waiting on David. So I heard back this weekend, and we're going to be interviewing Rocky. So Rocky is a platform, a DeFi platform on Canton Network, and they're about to go live. And so I reached out to them and asked them if they wanted to, come on the show and do an interview, and they said that they do. And so, we'll let you know kind of as this develops. But as soon as they go live, they're going to be coming on the show. How's it going, David?
Doing well, Mike. Doing well. How are you today? Looking forward to seeing what's going on in the news, man. I noticed that Bitcoin had a little bit of a pump today, and we could take a look at some charts if you'd like to in the first couple of minutes of the show. All righty, man. Let's do that. So I'm going to go ahead and share my screen here. Let's jump on in and take a look and see what is going on in markets today. Let me go ahead and share TradingView, and let's run through this together. So first things first, let's just take a look at BTC. So it's still the month of July. And in the month of July, in the Bitcoin midterm year, in the Bitcoin bear market year, in the month of July, you tend to get a rally. That's according to the Bitcoin prophecy, which, I got to say, Mr. Benjamin Cowan is the very best at reading. He's absolutely the best at reading that Bitcoin cycle pattern. Now, what I see here, if we zoom in here just a little ways, is a couple of different patterns forming. So number one, if we zoom out to the weekly, on the weekly, this is a falling wedge. So this pattern for BTC on the weekly, this is extremely bullish. However, if you zoom in from the weekly to the daily, and you take a look at this daily, Bitcoin is trading well below its 200-day moving average. So that is not bullish. That's a little bit bearish. As they say, nothing good ever happens below the 200-day moving average. So we've got the 200-day drawn on the chart here. If I go ahead and remove that 20-day, we've also got this level of trend line support. And so, BTC moving back on down towards this level of trend line support, this, I think, is going to be the important line in the sand this summer for BTC. If this level of trend line support fails, then I would expect Bitcoin to first make a move down towards, let's call it 58K, but I don't think that would hold. And I would expect Bitcoin to make a move all the way down towards 49, something like this, because that's where we had support back in August of 2024 when Bitcoin and many other risk assets had a flash crash on the back of that Japanese yen carry trade unwind back here. So that is the level of support that I expect Bitcoin to make a move down towards this summer. So that was a little bit about Bitcoin. Now, if we zoom in even a little bit further, maybe to the hourly, overnight, when the futures opened yesterday on Sunday, futures opened, Bitcoin ripped. But then when we got the cash market open this morning, the S&P cash, when that index opened, Bitcoin dumped. So I'm just thinking to myself, okay, Bitcoin is trading like a risk-on asset. And if we take a look down my watch list here, we've got to continue to watch these big tech stocks. These are the generals. So Google, big day today so far, bouncing 2.87% on the session into this gap fill. So, Google has this big earnings gap from
Oh,
last week. Yeah. So basically, we need to see Google fill this gap and continue to hold this level of trend line support here. So this is long-term trend line support. And the fact that Google has been able to hold this level of trend line support, even though it gapped down, hey, that's bullish. The fact that it's able to hold this trend line support. But, Mike, the more that I dig into that AI trade, all of those data centers that are being built, and a lot of the spending commitments by OpenAI and Anthropic, it seems as though they're going to be unable to meet those spending commitments because those businesses just don't make enough money, man. So watch Google. But I think we're also going to get earnings from a handful of other big tech stocks this week. So Apple, AAPL, is going to report this Thursday. And Apple printed a fresh all-time high today. So, Apple at the open, ripping higher. Fresh all-time high for Apple today. Now, the thing about Apple is that Apple does not have, $1 billion in AI data center spending capex, unlike all of the other big tech names. So Apple is being rewarded for that, while Google has been punished for its increasing AI capex. If we take a look at NVIDIA, NVIDIA is going to be reporting, let's see, when does NVIDIA report here? So NVIDIA reported last back in May, and this is an hourly chart. So if I zoom out here, yeah.
Wispy is calling you out.
Oh, Hex. Yeah, fuck Hex. Some bullshit. Man, that guy, Richard Hart, man, what a dirtbag. But so NVIDIA reports in August. So this is going to be really important to watch. Let's see here. I think that there's another big tech name that reports this week. Is it Amazon? Yeah. So we get Apple and Amazon this Thursday. Those are going to be market moving for sure. And then if we take a look at Meta, are they this week? Okay. So we get Meta on Wednesday. So Meta on Wednesday, we get Apple and Amazon on Thursday, and Microsoft we get on Wednesday. So Meta and Microsoft on Wednesday, Amazon, Amazon and what was the other one? Amazon and Apple on Thursday. So Amazon, Apple on Thursday, Microsoft, Meta on Wednesday, and then Oracle. I'm just kind of curious, when does Oracle report? Because they took on a ton of debt to be able to get a piece of the AI data center trades, and they're in September. So we're gonna have to wait a while for Oracle. But yeah, so Wednesday and Thursday this week, man, that's going to move the market. It's going to move the NASDAQ. And the NASDAQ broke down as of today. So this session today, we're getting a breakdown out of the NASDAQ below this level of horizontal support. So the next level of support for NQ comes in down here at 26.6. So yeah, gotta watch NQ. It's rolled over. That's what's happened. It's rolled over. And with Bitcoin trading 64.6, I'm just thinking that Bitcoin might have another couple days on the upside. These markets have been very resilient, but the bigger markets to watch.
Some people this morning and over the weekend that they're trying to paint a picture, and I don't agree nor disagree, but they're trying to paint a picture that the bottom may be in already, and that the October thesis is out the window. I mean, what are you seeing that either supports or debunks that?
I disagree. And the reason why I disagree is I believe that the valuations for those big tech names are, stretched. Let's put it that way. But also, when I take a look at the bond market is giving us warning signs. So with the 30-year, up at 5.13%, that is an elevated yield. And so you got to ask yourself, if you're an equity investor, like, what are your 5-year expectations for holding the S&P 500? What type of dividend yield do you expect? What type of real yield do you expect from holding the S&P? What type of growth do you expect from holding the S&P? Because the S&P at 23 times forward earnings, the expectation over the next 10 years is that you get a return of zero. That's what's happened every time the S&P has ever reached that type of PE. So I'm just thinking to myself, well, with the yields up at 5.13%, the federal government showing no signs of curtailing deficit spending, the Japanese government starting to really deficit spend into oblivion too, USD JPY at 163.69 breaking out. I think something's got to give in the bond market. I'm also seeing bond spreads start to widen for these big tech names. That is not a good sign. That's like the canary in the coal mine type of thing, because the bond traders are smarter than equity traders. So bond traders are going to react first, and then equities are going to catch up later. And it's a midterm year. So in a midterm year, I don't think we've had a positive midterm year in terms of S&P 500 returns, like for 4 decades or something, like a long time. So I would expect that pattern to hold. And the bond market is giving us warning signs. It's a midterm year. It's a Bitcoin bear market year. And for anyone who's calling the bottom in BTC, I mean, look, I want one of their crystal balls. They got a crystal ball? I don't have a crystal ball, know. So, but I see a bear flag. I see a bear flag here, and this is the third bear flag, and this is within a falling wedge. So you got bear flag 1, bear flag 2, test the 200-day moving average, just like 2022, just like 2018, and bear flag 3. So I think that we test those August 2024 lows at 49K. I don't think the bottom's in yet for Bitcoin, and I think that alts are going to have a rough rest of the summer. That's what I think. So,
all righty. I appreciate you guys. I don't know what these jewels are, but
I have no idea either, man.
I looked it up, and it gave me some like really complicated explanation. But I appreciate you guys. I mean, whatever this is, it just it shows support, and I appreciate you. All right. So it looks like Crispy saying Trump's losing his handle on the market manipulation, especially oil and bonds. In your opinion, Tucker, Sean Ryan, etc. Pentagon questioning whether Trump has a legit way out of war. I think we are going way down.
Yeah, Tucker Carlson, man. What is that meme? They call it the tuck face. You know what I'm talking about, Mike? The tuck face. This is the tuck face right here. Let me pull this up real quick. There it is. That's the tuck face. That. So I mean, this guy, dude. I remember him when he was on Fox, and now he's got some show on X, and I mean, like, he just seems to me like he's just super anti-Israel. I think that that's what those two guys have in common, that they're just super anti-Israel. And it's like, okay, well, are you going to be like more anti-Israel, or are you going to be more anti like crazy Muslims like bombing and committing terrorist acts across the world and potentially getting their hands on a nuclear weapon? So like, I'm all for destroying Iran and their ability to make war. I think that that's a net positive for the entire world.
I would tend to agree. And no matter if you support Israel or not, just from a purely logical standpoint, they are a major funder of global terrorism, and that's a fact. I mean, they're the ones that fund and train most of the different terrorist organizations, all over the world. So. And that's I've seen like actual intelligence reports that support that while I was in the military. So, there's that. So,
anyway. So Mike, real quick too, Sean Ryan had Candace Owens on his show recently, and that bitch is crazy as fuck, man. So like, I don't know. Yeah,
but
yeah.
We'll save that for Thursday. All right. So it looks like Canton Network released their H1 2026 key findings, Palladium Labs did. And so in a 51-page State of Canton Network H1 2026 report maps the network's growth across infrastructure, applications, and institutional deployments, including more than 490 ecosystem participants and 9 trillion in monthly volume. 9 trillion, not billion, trillion. So Canton Network at a glance. So more than 490 registered ecosystem participants, 162,000 plus active addresses over 24 hours, 655 active validators, over 45 active super validators, over 9 trillion in monthly network volume, 383 million in fees over 180 days, 345 billion in real world asset value, 38.5 billion CC in circulation, 118 featured applications, and more than 50 Canton Foundation members. The report organizes the ecosystem into 16 categories spanning infrastructure, applications, and institutional deployments. So let's see if I can break this down. So I mean, what crosses your mind when you hear those numbers, David?
I just think burn mint. That's what I think. Because when I'm taking a look here at the burn mint equilibrium right now, as of today for Canton, it's sitting at 0.67. So that to me is the important number for, number go up for the CC coin. So, I mean, all of the tech, all of the building, this stuff is amazing. These developments are very, very positive. But it's got to result in that BME going up. And it looks like it is. So I think that this is a huge net positive. I mean, I haven't seen this type of development on a chain since, like 2020 with Ethereum, or maybe 2017, where everyone was gung-ho to build on ETH. I think that people are gung-ho to build on Canton now. And so we're seeing that with all of these different protocols getting launched. And take a look at the people who are backing this stuff. A16Z crypto, they don't mess around, man. Those guys are serious and they're very, very good at what they do. And it's not just them. There's a lot of other VCs that are jumping in. And the fact that Broadridge is distributing its repo volume onto Canton Network, it looks like what, 8 trillion in monthly repo volume on Canton and 400 billion in RWAs on Canton. I mean, dude, this is just amazing stuff, man. So Canton it looks to me like Canton has been selected because it works by these big institutions for them to upgrade their backends, upgrade onto digital rails, upgrade onto Canton rails. And so what does that mean for, XRP and XLM? I think they kind of missed the boat, man. I think that they're being left by the wayside because it looks like these banks have chosen Canton. Connexus is JP Morgan's chain, integrates natively with Canton. So, I'm just thinking to myself, I want to bet on what I think is going to be the winner. And I think CC is going to be a winner out of all this. I mean, many of these protocols haven't even gone live yet. And, the handful of
they've been live and nobody's adopting them.
Well, I mean, you're talking about the retail facing stuff that really hasn't really caught much traction yet, I think.
I just mean that, there's a lot of projects out there that claimed they were going for institutional adoption and just, a lot of them just are not being adopted. We see a little bit of traction, and I keep picking on them because, they keep on railing on me on X, but, Kita.
You're getting railed on X, Kita, by Ketards?
Yeah. I say anything that they consider, bearish on their project, and they just come out of the woodwork and, want to, start calling us a joke and all this. And I'm like,
I think it's fake. I think they're fake. I don't think they're real people.
I keep telling them, like, listen, guys, we're stating the good and the bad. You're just choosing to focus on the negative, and instead of actually, trying to refute what we're saying, you're just going for the personal attacks, calling us a joke and stuff like that. And that's fine. You can say whatever you want. I don't care. But
sure, all good.
But to simply just say that what we're saying is factually wrong or incorrect, I've repeatedly, over and over again for months now since we did our deep dive, I've told you, if we're wrong on something, there's one person that took me up on it. And I'm trying to get him to respond because I apologize. He pointed out something that we got wrong, and I want to make the adjustment. But because of all the noise of all of you kicking and screaming in our Discord, I lost track of the chat, and so I need to talk to him again. But Other than that, nobody's taken us up on it. And we've done this with every project because we're not going to get everything right. We've told you, tell us what we got wrong, cite a source that proves we're wrong, and we'll change our narrative on it. But until then, your feelings got hurt. That's it. That's the bottom line. We called your baby ugly, and you're kicking and screaming about it. So,
and it's like, hey, you know what? If you guys want to, make your case, right? Cite some evidence. Jump into the node.pro, hop into the community, and make your case. Cite some evidence. Here's Exhibit A. And if it makes sense, great,
Right here. Go to the node.pro community and post. Just say, hey, saw that you guys did a deep dive on X, on whatever the project. This is a link to some information that you might find helpful because you said this, but it's not correct. And this is the correct information. And tag me in it, tag David in it, and if it checks out, we'll change it. We'll change our deep dive material. So we simply want people to understand the project. I am a massive bull on Canton Network and Aerodrome, my two largest holdings. But I'll acknowledge, David is not bullish on Aero, and he loves to point out all the negative aspects of it, and I appreciate that about it.
So I don't actually enjoy it. I don't enjoy it. I don't love pointing out the negative aspects. I just, I see what I see about it, and I have to say it. Like I'm not going to hold it back. So.
No, but I appreciate it because it forces me to look more critically at what I'm most bullish on instead of getting caught in that echo chamber, because it's so easy to do, to just seek out that confirmation bias and the things that make us bullish on these projects. So yeah, it's so important that we seek out a full picture. We should be seeking out negative or bearish information. I mean, don't just listen to it and then like sell your bag, but listen to it and make sure that they're citing their source. Go and check the cited source like we do on all of our deep dives. We have like 2 to 3 pages of hyperlinked, in our source document. You can go here. Every single one of them. You can go to the bottom. You scroll all the way down. You go to the source document. Scroll all the way down to the bottom. And this one, you have 2 pages on render of all of our cited sources. This is where we got the information to build our deep dive. And we do this on every project. So you can't just come at us and say we're a joke and say that our information's incorrect. We got it from primary sources. Most of the time, the majority of it from the official documents. So anyway, enough about that. Let's get back.
So bringing it back to Canton, Mike. Back to Canton and these dApps on these retail facing dApps on Canton. So I'm going to buy a Cypher Rock X1 today. I think I'm going to do. I'm going to do just like a little bit more research. I wonder. I don't think that Trezor supports Canton. I'm pretty sure it does not. I'm just going to check real quick, but the reason why,
No, go ahead.
So what I'm looking to be able to do here is I need to be able to self-custody CC. Like I will not custody CC in a software wallet. I just can't do that. So that means I needed to, number one, find a hardware wallet where I can self-custody CC. It looks like the Cypher Rock X1 is the one that allows me to do that. And I'm over here on Trezor's website, and I just typed in CC, and it doesn't look like they support. No, they don't support Canton natively, and neither does, I don't think that Ledger does either. And Ledger, the important bit of software on those Ledger devices is actually closed source, which is no bueno, not good.
So Risky Capital, welcome to the show, was reading Canton's white paper, and it said it would have 100 billion tokens after 10 years of launch, and after that, 2.5 billion token inflation yearly. So yes and no. So there is that token inflation. However, it uses a burn mechanism. So all fees, 100% of the fees paid on Canton Network go to buy back and permanently burn the token. And that's what we're talking about. Here, I'll pull it up real quick. And full transparency. Like I said, we point out the the bearish aspects on these projects as well. So Canton right now is inflationary because it is below this 1. Right now we are sitting at 0.67 or 0.68. So basically what's going on right now is Broad-Ridge's repo market is what's burning the majority of the token right now. With increased network usage, the burn rate increases. And so to be a validator, super validator, to use the network, all of that burns the token. So it's much like Hyperliquid. If usage on the network goes down, then it gets more inflationary. If there's more adoption and more fees being generated and more validators and super validators, then the burn goes up. So it really just depends on if you feel like that Canton is going to grow in the future, and that is what is going to make the token deflationary. But you're half right about what you're saying about their white paper. It just from a purely, if you ignored the burn, what you're saying is 100% correct.
Yeah, I think that it will eventually become deflationary. That's the idea anyway.
Yeah.
And good afternoon, Ivan Kareev. Good to see you again. So what I'm thinking about here with Canton, though, is I want to be able to use these retail-facing dApps. So, Cantex, for example. There's another one called Tradecraft. There is a peer-to-peer payments service called Contara. There's another one called Canton Loop. So I'm really interested to use some of these retail-facing dApps on Canton, but I need to be able to use them from my CipherRock X1. So that's what I want to learn about. I want to figure out how can I use these retail-facing Canton dApps using a hardware wallet, because that's what's most important to me is maintaining self-custody.
Well, when we interview Rocky, we should, that's something that we should ask them is, what wallets, their platform is going to support.
Yeah, no, absolutely. I think that if it supports like Wallet Connect, or if it supports, for CipherRock, there's a piece of software called CY Sync. And then there's a Nightly wallet is like one of the primary Canton ecosystem browser extension wallets. So
yeah, I'm using Braun. I actually was taking part in earning free Canton by holding the Braun token and holding my some Canton on the platform. And for like a couple months now, I really haven't been earning anything other than like the 2 Canton a day for having my account on Braun. So I actually swapped with these Canton lows that we've been at. I actually swapped that Braun token, which is basically pegged to the dollar, into more Canton. So I plussed up my Canton bag. But yeah, it's the Braun wallet is the best wallet that I've personally found so far. And I'm not saying that because they don't sponsor us. I'm not incentivized in any way to say that. It's just the one that I found that I really have enjoyed using.
So what was the DEX called? Rocky DEX? Rocky? Yeah, see, for me, Mike, I would really like to figure out how I can earn some yield on CC while maintaining self-custody in a hardware wallet. And, I'm thinking that maybe there's a couple of money markets native to Canton Network that I could, buy some CC with stables and then put that CC to work in a money market. And I want to be able to do that while maintaining self-custody. So that's what I'm looking forward to figuring out how to do here. I think that I'll be able to do this using that CipherRock. But since I haven't done it yet, I'm a little bit unsure So yeah, man, definitely going to continue to research this here. And I'm looking at Cantex right now. Do you know, are there any retail-facing money markets on Canton? I believe that there are. Doesn't that count?
I know there's a bunch that are about to launch. There's a bunch of stuff being built right now. So let's finish going through this news because this is going to give us a snapshot and probably answer a lot of the questions we're asking.
Cool.
Digital Asset, the builder of Canton Network, just finished a $355 million funding round that was led by A16Z Crypto, included participation by BNP Paribas, Citadel Securities, HSBC, a major bank, TradeWeb, and the Abu Dhabi Investment Authority. They also highlighted the growing use of Canton for tokenized financial market infrastructure. Those that don't know, the DTCC just did a soft launch for stocks on Canton Network, and with a full launch being projected for October. So very bullish about that because that's just going to bring transactions and volume and transaction fees and increase the burn. So looks like other developments include institutional tokenization platform T-Rise on Base Network, adopting Chainlink to support on-chain proof of insurance for private credit assets. Looks like Palladium also launched the Genesis Fund, a 10 million Canton Coin grant program. The fund is intended to support applications, infrastructure, tooling, integrations, research, and financial innovation across the Canton ecosystem. So it looks like Canton recorded 57.3 million in fees over 30 days. The figures shown on other networks included 25.8 million for Tron, 13.5 million for Solana, 10 million for Binance, and 8 million on Ethereum. So Canton also recorded almost 13 million over 7 days and 2 million over 24 hours in the same comparison. So protocol fee comparison. Canton is blowing everybody else out of the water as far as fees and revenue being generated. So very, very bullish on this.
Yeah, me too. 100%.
Across all three metrics. So 24-hour, 7-day, and 30-day. Much more than Base, Polygon, Bitcoin, Ethereum, Binance, Solana, Tron, and Canton is just getting going. I mean, to be honest, really like 95%, if not more, of their network usage right now is simply that Broadridge repo market. That's it.
Yeah, so what I'm looking for right now, Mike, is I know that Canton Army on X, they have a post in there with links to all of the retail-facing Canton dApps.
Yeah.
That's what I'm trying to find. I'm trying to find that post because I want to see, I believe that there are some money markets that are live.
I actually posted it in our old Discord too, in the alpha section.
So when I find it, I'm going to post it in the Node.pros community.
All right. So this will address the question in the chat about the burn mint model. So the new Canton coin is issued as compensation for productive work activity. At the same time, transaction fees continuously remove coins from circulation through traffic burns. The report's chart tracks monthly issuance and burns between July and June, following the January 1 halving. Monthly issuance settled at approximately 0.65 billion CC, while monthly traffic burns increased approximately 0.5 billion CC. The chart shows the mint burn figures moving closer as network and application activity increased. So, because of the halving and because of the increased network activity, we're getting closer to that, what's called equilibrium. So that was it, the BME. So once we hit that mark of 1 and exceed that, then we become deflationary.
So
Uh,
it looks like cantonnews.org, Mike, has a Canton Network starter guide. And this is kind of interesting. I'm just going to put this in the Node.pro community for anyone who wants to check it out.
okay. All right. So here's wallets. The report describes a wallet market serving retail, institutional, and self custody users. Loop Wallet and Send are highlighted as retail facing products, while Braun, Cantor 8, Nightly, and Console wallets support additional institutional and self custody workflows. Braun raised 15 million seed round led by Finastra Capital. Cantor 8 was selected by Adena Capital as an infrastructure provider for sovereign asset tokenization. These applications form part of the broader ecosystem mapped in the report. So, yeah, if you're interested, this is on Canton News. Great place for anything Canton. This is where I find a lot of my alpha when it comes to the Canton project.
So, Mike, it looks like there is a money market on Canton. It's called All DeFi. It looks like the website is live, but I'm getting access restricted here because of the VPN that I'm using. It looks like they don't support Argentina at this point in time. The URL is, All
David's
DeFi.
David's in Argentina right now.
¿Qué onda? But yeah, man. So I'm still looking for a money market. I'm going to find one. There's another one called Allpend. And didn't we run deep dive research, Mike, on Allpend?
We did.
Did we? Yeah. So Allpend, for anyone who's curious, we ran deep dive research. It's in the Node.pro's Intel library. Just go to the search, type in Allpend, you'll find it. And we ran that on July 13th. So that is in beta. That's a money market that's in beta on Canton right now. So I'm telling you, man, I am going to find a money market where I can supply or collateralize CC to start earning some yield on it. And I really, really need to be able to do that while maintaining self-custody. So I'm going to find it. If it exists, I'm going to find it.
Well, here's a little bit of news. So we did a deep dive on this project. I believe it was the 16th of July. Let's pull this up. It was right about, no, it was the 18th. On the 18th of July, if you go in, we have the receipts. If you go into the Node.pro, into the Intel library, you'll see that we did a deep dive on Zama. I found it on a Saturday over the weekend, and on Monday we did the deep dive. And this thing, I let people know in our community, again, there on the Node.pro, that I was nothing major. That I put a couple $100 in it, and I'm up about 80% now on that trade. And I took some profits. I told myself if it got to like 80, 100%, that I'd pull out a good portion, just to kind of get my initial out, and then play with the house's money. It's the same thing I do when I go to Vegas and play blackjack. If I find myself up 100%, my original money goes in my pocket. I got a bunch of free drinks up to that, and I'm playing with the house's money. If I lose that, then I walk away. And basically, I got free drinks and entertainment for however long that lasted. So that's kind of how I'm treating treating this investment. But Zama, again, we did a deep dive. We're a lot of these projects that we're finding, and that either in part or in whole meet our trifecta. When it comes to actual real adoption, fees and revenue actually being generated, and the token having value capture. It's we're seeing a pattern that a lot of these are outperforming the rest of the overall market, and in a lot of cases, Bitcoin as well. So, and I'm hearing this narrative, on major news outlets and other content creators on X and on YouTube. We've been saying this for months and got beat up for it. Told that we didn't know what we were talking about, that, speculation was where it's at, and these are speculative markets, and that's how you make money. And yes, you can still make money, speculating. But the fact that you're starting to hear this from, very reputable sources, that they are starting to value these assets based on if they have value capture.
I mean, Zama has just been ripping. Uh, I mean, after breaking out from that little triangle pattern there, Mike,
Yeah.
it has ripped by 91%. And that's just over the last week and a half. So Zama definitely getting some love. Bitcoin finding some support here just over the last couple of minutes too. Back up, moving towards 65K again. Now, I do think that Bitcoin is likely to, over the next couple of days, have a little bit more upside. I really do think that. I think that it probably rallies up to like 67 or 68. But I'm laying out shorts. That's what I'm doing.
How did I do on my lines?
Not bad. No, they look great. You got resistance, you got support, you can see the breakout. It looks perfect.
Perfect. I'm learning something. I leered something from David.
Doing some leering.
Yeah, I did some leering. So no, I mean, like I said, it was a bit of a speculative. This was a speculative play. I'm not going to pretend like I had a crystal ball. Threw a little bit of money into it. I like the narrative. It's a privacy token. We'll go down here and read a little bit about it. But and I'm not saying run out and buy this. I mean, I would not buy into all these green candles personally. You do you. Again, we're not here to influence anybody. But it's a confidential blockchain protocol, or simply the Zama protocol enables issuing, managing, and trading assets confidentially on existing public blockchains. So basically, it brings privacy to existing blockchains like Ethereum, Solana, anything that doesn't have privacy. And this is what institutions want. This is what retail wants. They don't want everybody to be able to see what trades they're making. They don't want everybody to see what transactions they're making. So that's what made me bullish on this. Whenever I did the deep dive over the weekend for the Monday show, I shared it with the community, and I just told them, I'm like, hey, do your own research. I'm putting a couple $100 in, and I'm going to see what happens, because privacy is a huge narrative right now, and something that adds that functionality to existing chains. Why not? So,
sure. And it's been ripping too. Yeah. So, look, the market will oftentimes tell you what it thinks of a protocol via the price action. So if you see a token that is down only, that usually means that there's something broken, something wrong there. If you see a token that is actually performing extremely well, like Zama, well, it could mean simply hype. That's what it could mean. There's a lot of buzz around it, maybe a lot of market share or mind share around this particular token, or it could mean that there's something transformative going on there. Yeah. So that's where the deep dive research comes into play, though.
There's something there.
There's something there. That's right.
There.
Yeah.
So it looks like institutional treasury movements. So Bitmine reaches 4.8% of total ETH supply. Bitmine Immersion Technologies reported its total crypto, cash, and strategic holdings reached 11.8 billion. Staking and buybacks, BMNR now holds 5.787 million ETH, 4.8 of the total supply, with 4.91 million ETH, or 9.6 billion, actively staked through its Maven platform, projecting a 300 million in annualized staking rewards. They also completed an 11.6 million share equity buyback since July 1st. Something I was listening to, and maybe David, you can verify this. On some of the shows I was watching this morning, they were talking about that retail has kind of been out of a lot of assets for a while, but these institutions are really ramping up their buys of Bitcoin and ETH. And a lot of people are saying that that's the reason why we haven't seen even more dramatic pullbacks in Bitcoin and ETH while retail capitulates, that institutions are buying up people, retail selling. I mean, are you seeing any data that supports that?
Well, over the last two sessions, no.
Okay.
I'm actually seeing over the last two sessions for those Bitcoin ETF products, just about $500 million of net outflows.
Okay.
So we don't have any data yet for the session today because, of course, the session has not closed. The markets are still open. So we will maybe about 45 minutes after the market closes today at 4 p.m. Eastern Standard Time, we'll start to get the Bitcoin ETF flow data over on Farside. But what I see from Friday and Thursday of last week is $500 million of net outflows. So, my thought process here, Mike, is that institutions are starting to allocate to Bitcoin, to Ethereum, and, to a lesser extent, some other altcoins. But, the net flows, net over the last year have been extremely positive for the Bitcoin and Ethereum ETF products. So I'm just thinking it's very, very difficult and kind of a fool's errand to try and call a bottom or call a top. So what you do instead is you have an investment thesis and you say to yourself, hey, you know what? I want to accumulate this position in asset ABC, whatever it is. And you want to do that over, X period of time. And so that's what these institutions look like they're doing. It looks like they're starting to really, accumulate large positions in Bitcoin and Ethereum. And so you were talking about Bitmine. Bitmine, that's Tom Lee's outfit. So 5% of the Ethereum network, I think that he's going to do extremely well with that investment. And unfortunately, right now, both he and Michael Saylor are sitting on multi-billion-dollar losses, unrealized losses. So that is, obviously not what they want to see. But what Bitmine Immersion Technologies is doing with a lot of that staking yield is they are going to redistribute it into the ecosystem in the form of, I think, grants for developers. So that's going to be a big deal. It looks to me like Ethereum is going to be implementing some type of privacy layer in the not too distant future. So that is going to be make Ethereum a direct competitor to Monero and Zcash. And also potentially to Canton, because if there's a privacy layer built into Ethereum layer 2 chains, which are fast and scalable, then maybe institutions could at some point in the future be interested in moving some of their operations onto Ethereum layer 2s or creating their own Ethereum layer 2s, because if there's a privacy layer, then they don't have to worry about their transactions being exposed. So that's going to be a big deal, but it's not real yet. It's not there yet. So, yeah.
I mean, there's definitely more to Canton than just privacy. So, I mean, but yeah, I mean, I think that, it's definitely that, they don't have a corner on the market. And, it is important that, we acknowledge that, we're still very early. And, obviously, Canton has the attention of institutions, but, and institutions, move slow. Institutions don't make rash knee jerk decisions and bounce around. They have they're very cumbersome. They're very kind of like the military. Um, when it comes to the paperwork or red tape aspect, you need the S1, the S2, the S3. In institutions, you need legal to sign off on it. You need the CEO to sign off on it. You need all operations to sign off. Everybody needs to get their sticky little fingers on it and make sure that there's no issues. That they say, yep, this is good. And then you got a board you got to deal with, and so it takes some time, for things to change. So um, yeah, it'll be interesting to see, how it all evolves. And with interoperability, you know, they wouldn't necessarily need to leave, Canton Network to utilize Ethereum. Especially like with Zenith, where they're onboarding, EVM compatible DApps and things like that. So with the interoperability, I mean, really, people on Ethereum and Ethereum layer twos potentially could be using Canton Network and vice versa, and Solana, and all these other ones. I think it's going to be.
That's live right now, Mike. In
Yeah.
fact, just as you were speaking, I created a Loop wallet.
Mhm.
So I created a Loop wallet. And have you ever heard of a DApp on Canton called CanCore?
Yeah, I think we did a deep
So,
dive on it, or Jeff did.
okay, so let's take a look at that CanCore deep dive. I want to see if that's in our library. CanCore. I don't see it.
No, I don't either.
So let's do that. Let's do a deep dive on CanCore at some point this week, because what I'm looking for here is, I need to be able to on ramp into the Canton network ecosystem permissionlessly, and I need to be able to do that from my EVM or SVM chain accounts.
You can do that currently with the Braun wallet. You can send Ethereum, native Ethereum, into your Braun wallet and swap it for Canton or whatever.
Do we have deep dive research on Braun? I think we did at one point run through some type of research on Braun.
We did, but I think it was before we did the Intel library, so I might have to rerun it. Yeah.
So there's something about a wallet like Braun that I just want to learn more about it, because I would really prefer self-custody. And so what I see here with CanCore is, and I can share my screen and we can take a look at this. Yeah. This is actually kind of interesting. So let me go ahead and share CanCore. Let's take a look at this. So I'm going to zoom in so we can see this real quick. So my goal here is, if I go to trade and I click on new trades, I just want to make sure everyone can see this here. So I'm going to zoom in. So this is a beta product. So we're going to run through some deep dive research on this at some point this week. But what I want to be able to do is I want to use Arbitrum. I want to use USDC on Arbitrum, and I want to swap into native CC. And I want that native CC to land in my Cypher Rock X1. That's what I want to be able to do, because then I actually own it, I actually custody it. And, if I've got the asset, if I've got my keys on a hardware cold storage wallet, I trust that a hell of a lot more than I do any hot wallet. So
I'll tell you a little bit about Braun. So it is self-custodial. It doesn't use seed phrases. MPC, no seed phrase MPC architecture. Instead of traditional 12 or 24 word seed phrases, Braun uses multi-party computation and threshold cryptography. Your keys are split into cryptographic secret shares across multiple parties' devices, so that no single party, including Braun, ever holds or controls your private keys. On-chain settlement. Whether you are interacting with DeFi protocols or doing cross-chain swaps, transactions settle directly on-chain. Braun provides the client software interface and does not custody or hold your funds at any stage. Social recovery. Braun Guardian. So I made my brother Taylor my Braun Guardian. If you lose a device, access can be reestablished through appointed guardians using MPC share reconstruction, rather than relying on a centralized service desk or third-party custodian. So, basically, you give somebody, and they can't do it on their own either. Basically, you have to do it with them, and then Braun has like one of the pieces too, or something like that. So no one party can do it alone. So anyway, yeah, it's an interesting wallet, and it was really easy to set up, really clean UI UX, and a lot of cool functionality. You can even stake ETH. There's a bunch of different things that you can stake on there. Ton coin, you can earn like 16% staking your Ton coin on it.
Really?
Yeah.
That's pretty cool.
Yeah.
So, the thing that I'm excited about here with CanCore is it looks as though I can use USDC on Arbitrum as, the asset that I use to buy or swap into CC. And I could receive CC over here in CanCore. And then once I've got CC in CanCore, I could and I use Loop. So I could just send it to CipherRock. And then I would have self-custody of CC. So this is a brand new ecosystem to me. Just, starting to become a little bit more familiar with how to actually use this in practice. But this is exciting, man. Being able to swap into some CC natively like this, permissionlessly like this, this is what I think is super important. And then the next thing here is, okay, great. So after I swap into some CC and I've got it on my CipherRock, well, I need to be able to connect to Canton native dApps and actually use that CC in Canton native retail facing DeFi. So in order to be able to do that, I need to know what Canton native dApps exist. So that's the next step here, I think. And there seems to be a handful of them so far.
As soon as Zenith launches, I mean, you're going to have, all the, EVM dApps, and the Canton dApps.
Yeah, well, I mean, I think that we're probably going to have to wait a little while for developers to port a lot of dApps on over to Canton. And what do they call that? They're not calling them subnets anymore. They're calling them mainnet extensions, right? Yeah. I think. So, yeah, man. Canton network, I mean, getting in early to a new network is always, a risk. There's always a risk there, right?
It's speculative, yeah.
Yeah, it's definitely speculative. But I see all of the signs that I see here, all of the information that I see tells me that it's likely that we're going to see CC. I think it's likely that we're going to see CC perform well because we're seeing this massive ecosystem growth. We see all of these RWAs on chain. It's like $400 billion. We see multiple trillions of dollars settled in notional volume each month on Canton. That's repo volume.
9 trillion.
Yeah, man. So, I mean, look, no other chain can make those claims. Like it's the numbers, the size of the numbers for Canton just blow out of the water like every other chain. And so I think it's probably just a matter of time until that burn mint equilibrium rises above 1.0. So if we take a look at that real quick, statistics over here.
Really quick, what David was just talking, this is what we shared. This is the fees, being generated, in over 24 hours, 7 days, and 30 days. And I mean, pretty much if you combine everybody else, Tron, Solana, Binance, Ethereum, Bitcoin, Polygon, and Base, Canton is still generating more. I mean, like all of those combined, if you take 25 or 26 million, you take 13.5 million, you add all of these up, Canton is still earning more fees than everyone else combined.
Yeah,
and that's with one customer, pretty much.
I know. Imagine when there are a bunch of retail-facing dApps on the chain.
Yeah.
Yeah. So I think
now we got to point out, it's still inflationary. The token has been, going down price-wise. There is no guarantee that, the token price is going to go up. But, these are speculative assets. And if I'm going to speculate, I'm going to pick one that has, the fairest launch that I've ever witnessed in crypto, that has, some of the best tokenomics, for token holders as far as revenue share, and is generating the most fees out of the rest of the top contenders combined. I mean, if I'm going to bet, I'm going to bet on that.
So, Mike, did we ever run deep dive research on Helios Finance?
I don't think so, no.
So Helios Finance looks like it's the first neobank on Canton Network where you can borrow USDCX against your CC and spend that USDCX using a Canton coin-backed credit card. That is pretty cool.
Then we're doing a deep dive on Helios and CanCore tomorrow.
Awesome. Awesome. Yeah, man. These Canton native dApps, these are really cool. And the tokenomics that we see for a
They're
lot of
all
these.
tied into institutions. I mean, that's where the money, that's where the liquidity, the deep liquidity is going to be. That's where the volumes are going to be, to earn, fees and, things like that. That's what I'm betting on is, again, do your own research. I'm not saying run out and buy it, but that is where my money is because I want to do what David was talking about. I want to earn with my Kenton. If it ends up going to, a dollar, if it does like roughly a 10x from here, I want to be able to take, I'll take some profits, but I want to put the majority of it into a DeFi play that is going to earn me yield. But I'm only going to do that if I don't have to worry about impermanent loss. If I'm going to be able to earn enough yield, if it's a liquidity pool to counteract what I would lose from that impermanent loss or divergence loss, unless I can just lend it out, lend it out, earn 10% or something like that, done.
I'm just thinking about, I'm really looking for a lending market. I want a money market. That's what I'm looking for. So it looks like there are 6 of them as of right now. Acme Markets, All DeFi, Cashin, C-Note, Helios, and Rain. So it looks like there's 6 money markets, retail-facing money markets on Canton. And of those, All DeFi is live, Rain Finance is live, and it looks like that's it. So Acme is in private beta. It looks like Cashin is institutional, so you got to request access, and I'm sure some type of KYC, KYB, AML is required. But this stuff is super exciting, man, because if you can supply your CC, collateralize your CC, borrow USDCX against it, and then take that USDCX, swap it for further CC, supply that CC again, then you got a loop. You can lever your exposure to CC.
Interest rate arbitrage.
Yeah, you could do that too. So these types of plays, like we are the first channel talking about actual DeFi on Canton and running these types of plays. Like there's no one else that's talking about interest rate arbitrage on Canton retail facing dApps. There's no one else. No, I don't think it exists. So I'm going to pick up a Cypher Rock because it looks like that is the only hardware wallet that like actually truly supports CC natively right now. I don't think that there are any other hardware wallets that like truly support CC.
Well, let's make it a point to really go deep on some of these on Canton DeFi, so that so we can kind of front run
exactly
the launch of some of these and look for some really good opportunities.
100%. Yeah, I mean, because there's a lot of wallets, but I need a hardware wallet. I can't use a software wallet. So I think it's about that time. You ready to rock and roll into some of the deep dive research here today?
Let's do it.
Let's do it, man. So I've got, let me go ahead and share the correct screen. And for anyone who's interested in supporting us at the Node.pro, take a look at the weekly Intel overview. So these Intel overviews are published every Friday afternoon, just after 5 p.m. Eastern Standard Time. And it's a synthesis of all of the deep dive research that we run through each week. So Monday through Friday, we produce 2 pieces of deep dive research every single day. That means 10 pieces of deep dive research every week. Those get synthesized into one report that you can get delivered to your email inbox or read right here at the Node.pro in the Intel library. So this is $10 a month. Definitely think about taking a look at that. Okay, so today, Mike, which ones do you want to take a look at first?
Let's do Bitcoin covenants, just because of how important that is. And let's do this GeoNet. It's been getting a lot of mind share today, and it's similar to Helium, and I guess they're working with Helium is a little bit of the information that I saw when I was putting it together. So yeah, let's see what's going on there because it's a D-pin play. But I know covenants are really important for Bitcoin mainnet and a lot that's going on there. So
Awesome. So let's take a look at Bitcoin covenants. And a covenant is not a coven. This is not a coven of witches. It's not there are no nuns here. Okay, this is like complex cryptography, basically. So this is super interesting. I just want to pause here for a second and just let everyone know this is going to be really detailed, I'm sure, and really complex. So I've seen a couple in person. I've been to a handful of in-person events here in St. Petersburg, Florida, and Bitcoin. There's a Bitcoin group here where there are like legit Bitcoin developers. And whenever I've heard them speak about Bitcoin covenants, they talk about this stuff like it's the holy grail for Bitcoin, because it seems like it would enable like smart contract type operations on the Bitcoin layer one. So that's my preface. Let's go ahead and learn about covenants.
In early 2026, the economics of the fourth Bitcoin halving pushed the cash cost to mine a single coin to approximately $80,000.
Ouch.
Pure play mining operations were suddenly facing sustained unprofitability. Public mining entities, companies controlling multi-gigawatt power agreements and massive cooling infrastructure, began systematically reallocating their power capacity. They shifted focus to host artificial intelligence and high-performance computing, securing fixed, multi-year USD lease agreements with up to 90% operating margins. This chart tracking the network's 30-day moving average hash rate shows the immediate consequence. Hash rate experienced a sustained 13.2% drop from a peak of 964 exahashes, forcing a severe downward difficulty adjustment. With block subsidies permanently reduced and hardware migrating to AI data centers, the network faces a strict mathematical problem.
Mike, we've been talking about this, man. So those miners, that mining business model, look, the block subsidy, that block reward, after 2 more halving cycles, it will fall below 1 BTC. So what is going to continue to incentivize miners to keep their machines running? I think we need to see a massive increase in transaction volume on the Bitcoin layer one.
It requires a mechanism to generate massive, sustainable fee revenue for miners
without
expanding base layer block size limits, which would compromise node auditability. The architectural answer to this economic pressure is a protocol upgrade known as Bitcoin covenants. A covenant is a cryptographic restriction applied at the script level. When a piece of Bitcoin is spent, the covenant dictates the precise structure and destination of the outputs in the transaction that spends it. By enforcing strict rules on how funds exit a given address, developers can compress thousands of off-chain transactions into high-density settlement layers on the main chain.
But it also, and this is so cool, man, it doesn't just do that. It also allows you to like kind of sort of recreate smart contracts, but they're not smart contracts. This is not written in Solidity. This is like, it's a super complex way of creating those smart contract features.
This shift towards sophisticated cryptographic code generates the high-density fee revenue necessary to stabilize Bitcoin's physical hash rate. Under standard execution, proving ownership of Bitcoin relies heavily on signature verification. This authorization is strictly backward-looking. The script validates that the spender's signature satisfies the specific mathematical conditions of the spent output, completing the verification without any insight into where the money is headed next. In standard Taproot, validated signatures grant total spending authority. Funds can route to any arbitrary destination. Covenants replace this with forward-looking inspection, or introspection. The script evaluates the spending transaction's exact output addresses, amounts, and sequence numbers before allowing the transition. The primary mechanism proposed for this inspection is an opcode called Check Template Verify, or OPCTV. OPCTV operates through rigid template matching. The consensus engine computes a hash digest of the proposed transaction outputs and compares it directly against a predefined 32-byte hash commitment embedded directly in the spent output script. If the proposed transaction attempts to redirect funds to an unapproved address or alter the fee allocations, the hashes will not match, and script evaluation fails instantly.
Yeah.
Introspection shifts the Bitcoin.
So that's another cool thing about prospective Bitcoin DeFi is that everything that I know about it so far, Mike, tells me that it is much, much more secure than any other DeFi because basically, like, it's cryptography. It's not really code like Solidity or Rust. It looks like it's complex cryptography that recreates the features of smart contracts. So that means that, number one, you've got to be a brilliant developer to understand and build on Bitcoin. And number two, once you build something using Bitcoin like cryptography, then if it works, it's like it almost can't be hacked. It's kind of interesting. Maybe it's untrue to say that it can't be hacked, but it seems to be much more secure than EVM or SVM chain stuff.
Bitcoin base layer from a network of simple lockboxes into a highly secure system of programmable, unbypassable financial chutes.
Yeah.
Deploying OPCTV natively requires modifying the consensus layer via a soft fork, a process historically met with heavy developer friction and extended timelines. Bitcoin Pipes v2 bypasses this bottleneck entirely. It provides a cryptographic framework that enforces output restrictions off-chain without requiring any consensus modifications to the base layer. The system relies on witness encryption. Instead of locking a secret key behind a standard password, the key is encrypted under a designated mathematical condition, an NP statement. Off-chain, a distributed key generation committee generates a joint public key, encrypting the secret key under a specific covenant condition. To execute, a user provides a zero-knowledge proof satisfying the restrictions. This decrypts the key, allowing the spender to produce the L1 signature. To the main Bitcoin network, none of this complex introspection is visible. The final execution settles as a perfectly standard taproot key path spend. Recent optimizations to the PEEPS v2 framework have accelerated the underlying math, reducing the computation time so the entire key release process fits reliably within Bitcoin's 10-minute block window. This confirms that the network can support highly restrictive smart contract logic immediately, utilizing advanced cryptography off-chain rather than waiting for base layer consensus upgrades. Applying these programmable rules directly addresses the primary vulnerabilities in institutional self-custody. Traditional custody relies heavily on threshold multi-sig configurations. A compromised key or a coerced signer results in total loss.
Right.
Covenants remove this single point of failure by embedding multi-stage state machines into the script. When spending from a vault, the covenant forces funds into a temporary staging script, enforcing a mandatory relative time lock. If initiated by a compromised key, an emergency clawback transaction bypasses the time lock, instantly rerouting funds to secure offline cold storage. Beyond institutional security, covenants provide the precise architecture required to scale retail payment networks and replace legacy Lightning channels.
Yeah.
Legacy Lightning models require penalty-based state revocation. Counterparties have to remain constantly online and store heavy databases of historical channel states to defend against breach attempts.
Right.
Protocols like ARC utilize covenants to build shared join pools, shifting the network toward true non-interactivity.
So I'm pretty sure, Mike, that ARC got a $5 million investment from Tether recently. And I think that ARC is like one of these companies that's building a layer 2 solution for Bitcoin.
A service provider funds a single shared on-chain output restricted by a covenant. The output is mathematically structured as a tree, carving the pool into thousands of off-chain virtual UTXOs, or VTXOs. Covenants guarantee that users can unilaterally claim their funds from the pool tree at any time. They do not need the service provider or other participants to be concurrently online to coordinate signatures. Off-chain liquidity can be fluidly reallocated between users inside the pool without requiring constant base layer resets. By achieving non-interactivity, millions of users can hold verifiable, trust-minimized Bitcoin while generating only a fraction of the traditional on-chain footprint. Returning to the threat facing public mining operations, how does shifting volume off-chain generate the revenue required to keep physical ASIC machines running? The base layer cannot simply expand raw block space to accommodate higher transaction counts. Doing so degrades node decentralization. The network generates value via fee density. This measures the economic value compressed into a transaction.
That's why the miners right now don't want that proposal that would strip inscriptions and BRC20s out, because it makes each block more valuable to them to have all that bloat in there.
Pricing block space in satoshis per byte. A standard transaction occupies roughly 140 virtual bytes to settle a single payment. A covenant root settlement transaction occupies roughly 500 virtual bytes. While marginally larger, that single 500-byte transaction contains the cryptographic proofs settling thousands of off-chain virtual UTXOs and state updates simultaneously. The economic value compressed within that specific footprint represents millions of dollars in aggregate trade volume. Consequently, liquidity providers and roll-up operators are economically incentivized to bid aggressively to guarantee their settlement is included in the next block. This concentrates transaction fee density, driving rates up and generating significant total fee revenue per block, entirely within existing weight limits.
So you know what comes to mind now, Mike? It might make sense to consider investing in an ASIC prior to an upgrade like this, if you want to speculate on something like that,
It creates a sustainable economic engine to replace the declining block subsidy. This brings the equation back to massive industrial power grids and miners reallocating their resources.
Right.
Public miners are adopting a hybrid data center model, repurposing their multi-gigawatt power infrastructure to balance high-margin AI hosting with the opportunistic capture of Bitcoin block rewards. AI hosting contracts provide these companies with fixed multi-year USD revenues. Those 80 to 90% operating margins stabilize corporate balance sheets against the volatility of the halving cycle. The dedicated SHA-256 ASIC fleets that remain serve as flexible loads. When spot electricity prices spike, these machines can be instantly powered down to balance grid demand or prioritize high-margin AI computing without operational latency. But when massive covenant settlement transactions hit the mempool and drive fee density up to hundreds of satoshis per byte, those nimble ASIC fleets spin back up to capture the resulting block rewards. Covenants permanently align Bitcoin's cryptographic code with the physical demands of post-halving energy.
I didn't understand that.
Yeah.
I thought that they, it was one or the other. I thought that either they were mining Bitcoin or they totally removed themselves from that and went into AI. I didn't realize that they could, it was that flexible to where, like if whichever one is the most profitable, that's what they process.
I think it probably depends on the ASIC, or maybe it depends on the specific mining company.
I didn't even know it was an option, but according to the deep dive research, that it's the ability to bounce back and forth is there.
Yeah, I mean, so let's see. I'm over here in the community. Oh, there it is. It finally popped in. So jumping back in here to the community, let's see if it worked there. What I want to be able to do is I want to be able to share that piece of research. And I think there might be some type of a bug. There we go. Awesome. So covenants can keep the BTC mainnet secure well into the future. Awesome. There we go. Just posted that piece of deep dive research over there in our community. All right. So that was a little bit about covenants. Let's take a look and let's learn about GeoDNet. Awesome. Let's check this out. So DPIN, Global Navigation System. Awesome. So I know nothing about this, Mike. What is this?
Like I said, it's a DPIN play that I ran across this morning, and it saw some positive price movement, and it looks like it's getting some significant mind share. So I figured we'd look into it.
Sweet, man. Let's do it.
Right now, thousands of satellites are in continuous orbit, broadcasting a constant stream of standard navigation signals down to Earth. But by the time those radio waves reach the ground, they are distorted. Ionospheric interference, atmospheric friction, and slight drifts in satellite clocks introduce spatial errors, bounding uncorrected GPS accuracy to a 1 to 5 meter margin. To resolve these errors, engineers rely on real-time kinematics, or RTK. RTK uses permanent ground-based reference stations to calculate exact signal distortions and stream phase corrections directly to end-user receivers, locking in sub-centimeter precision. That specific level of accuracy is a strict requirement for traditional industrial sectors. Civil surveying, precision agriculture, and large-scale construction logistics depend entirely on exact spatial data to coordinate heavy machinery and map terrain. Emerging autonomous technology stacks also rely on this physical infrastructure. Without cryptographically verified sub-centimeter location authenticity, autonomous vehicles cannot navigate complex urban environments safely. The bottleneck limiting this spatial accuracy is legacy physical infrastructure. Traditional RTK networks, operated by legacy companies, rely entirely on centralized corporate capital to purchase hardware, secure real estate, and maintain reference stations. Establishing a traditional reference site involves specialized commercial real estate leases, dedicated utility contracts, and local maintenance technicians. This fixed overhead drives the total capital outlay per incumbent station between $5,000 and $20,000. This exorbitant capex requirement structurally restricts global geospatial coverage. Centralized networks simply cost too much to build everywhere, creating a massive market vacuum for a more cost-effective engineering architecture. GeoNet is a decentralized physical infrastructure network that replaces centralized corporate capex with a global, crowdsourced hardware model. Instead of leasing commercial real estate, independent operators purchase standard base station hardware for roughly $700. They install the units on private residential or commercial rooftops, providing their own power and internet connectivity at zero recurring rental expense to the network. This chart compares the capital expenditure required to deploy a single network node. While legacy networks spend up to $20,000 per site, GeoNet's crowdsourced model causes that deployment cost to drop to just $700. By decentralizing the upfront costs, the protocol achieved massive global scale. GeoNet now operates over 17,000 active, verified base stations deployed across more than 147 countries. Many early decentralized networks attempted similar physical expansions, but they relied entirely on circular, inflationary token rewards, without ever generating underlying commercial data sales to sustain the project. GeoNet ties its protocol survival to a specific mathematical state known as deflationary equilibrium, the exact point where enterprise data revenue permanently outpaces programmatic token inflation. The mathematical foundation of this ecosystem starts with a strict, immutable hard cap. The total supply will never exceed 1 billion Geo tokens. During the initial rollout, early network participants received elevated token rewards. This temporary inflation compensated operators and successfully bootstrapped the network's baseline geographic density. This chart graphs the protocol's programmatic decay function. As the network matures, token emissions undergo a strict annual halving every July 1st, systematically reducing hardware mining rewards over time. Tracing the historical step-down values, the maximum daily reward per station dropped from an initial baseline of 96 GOD down to 48, then 24, reaching the current state of 12 tokens per day. The upcoming halving in July 2026 will cut the maximum daily base reward even further, dropping it to just 6 GOD per station. Alongside this decay function is a rigid hardware constraint. As of June 2025, primary mining emissions are restricted exclusively to advanced triple-band stations capable of tracking all major satellite constellations simultaneously. This mathematically guaranteed emission decay systematically starves the network of programmatic inflation, steadily stripping away structural sell pressure from node operators liquidating their rewards. As the token supply diminishes, external demand expands. This demand is generated entirely by Web2 enterprise clients purchasing high-fidelity spatial data streams. Because the protocol runs on crowdsourced hardware, it offers highly aggressive commercial pricing. Clients pay $400 a year per active end device, drastically undercutting legacy RTK subscriptions that average $2,500 annually. This diagram illustrates how GeoNet scales commercial sales. The protocol uses a 50-50 revenue share model with strategic original equipment manufacturers. A standard $400 payment splits into two distinct streams. $200 is retained by the third-party reseller, and $200 is remitted directly to the GeoNet protocol. The remaining 80% of gross network data revenue is routed into a smart contract that automatically executes open market buybacks, actively acquiring GOD tokens. The tokens purchased on the open
That's pretty good. That's pretty good.
Yeah, and it looks like it doesn't
permanently burned via smart contracts, instantly removing them from circulation. This 80% buyback and burn mechanism hardwires real-world enterprise data consumption directly to continuous token supply contraction. Net token deflation is the exact mathematical moment when the total fiat value of those burned tokens exceeds the total fiat value of new tokens emitted as mining rewards. GeoNet's commercial momentum is accelerating. Annual recurring revenue expanded from $630,000 in early 2024 to $5.6 million by late 2025. This chart models the path to equilibrium. The descending red curve represents the total fiat value of token emissions, dropping steadily due to the mathematical certainty of the annual halvings. Meanwhile, that rising annual recurring revenue generated a trailing 30-day token burn run rate of approximately $4.5 million by late 2025. We plot this expanding burn rate as the rising green curve. The intersection occurs exactly where the burn curve crosses above the emission curve. At this precise point, the fiat value of tokens destroyed is mathematically greater than the fiat value of tokens created. Quantitative tokenomic models indicate this net positive threshold will trigger when the network hits roughly $15.1 million in annual recurring revenue, projected to occur between 2026 and 2027. Crossing this specific revenue threshold officially transitions the token from an inflationary bootstrapping mechanism into a deflationary cash flow-backed utility asset. Reaching this economic equilibrium requires the protocol to mature. It has to pivot its internal incentive structures away from sheer node count growth towards strict operational efficiency. The GIP7 architecture upgrade executes this pivot. By establishing Solana as the primary Layer 1 settlement environment, the protocol accesses deeper exchange liquidity, reduces transaction costs, and allows for tighter integrations with the broader decentralized infrastructure ecosystem. GIP7 also introduced SPL-based performance staking. Station operators and delegators can now lock circulating token supply directly behind qualifying hardware nodes. This visual demonstrates how the staking mechanism aligns yield directly with reliability. Rewards scale dynamically based on a rigorous 30-day rolling average, requiring nodes to maintain between 98% and 99.9% uptime to maximize returns. Following this, GIPH strictly hard caps active location NFTs at 20,000. This prevents redundant geographic coverage in saturated markets and consolidates liquidity where the network actually needs it. Together, these governance upgrades ensure the decentralized physical network maintains the exact spatial quality control required to match the strict service-level agreements demanded by legacy enterprise clients. Zooming out, we observe the macro integration pipeline. Autonomous drones and precision agriculture fleets demand rigorous, multi-year testing cycles before reaching the market. Because industrial testing and field certification cycles require 12 to 24 months, enterprise clients face incredibly high switching costs once GeoNet correction streams are successfully deployed into their hardware. This integration friction establishes highly stable, recurring revenue retention that survives volatile macroeconomic cycles. Once embedded into the equipment, clients do not turn it off. GeoNet has proven that a decentralized hardware model can achieve denser geographic coverage at a fraction of the capital cost of incumbent multi-billion-dollar corporate operators. The economic engine driving this network relies entirely on programmatically declining token emissions, paired with expanding open market buybacks driven by traditional commercial demand. By successfully substituting centralized CapEx for a crowdsourced network and mathematically linking data sales to token supply contraction, GeoNet establishes the definitive blueprint for sustainable, decentralized physical infrastructure.
Dude, that's brilliant. So what's the token? Like, how do we gain exposure to this thing?
I'm actually on Coinbase right now, buying a couple $100.
Yeah, I mean, this looks pretty smart, man. So the way that I would find it is I would hop on over here to DeFi Llama. I would go to Jupiter.
I just went
And
to market cap to see where it was sold.
yeah, so here, let me hop on over to CoinMarketCap. Let me do that too. I'm looking for GeodeNet. There it is, GEOD. Looks like an FDV of $261 million. We got an unlocked market cap sitting at 195 million, net market cap 114 million. And if I scroll down here, I can see the decentralized markets where I can swap into this token. Looks like I can do that on Orca, on Radium. It looks like the token also exists on EVM chains. So Uniswap v3, Uniswap v4, looks like it's on Polygon. So I'm going to take a look at this on Solana because I think that this is a Solana native protocol, right? So that means I want to start over here on Jupiter. We're going to head to Jupiter's website, and I'm looking for, I want to swap, maybe some Sol into GEOD. GEOD. Okay, so I want to make sure that I'm looking at the right token because there's almost always some type of knockoff over on Solana. So this has the little check mark, but another way to verify that would be to hop on over here to CoinMarketCap. Like so, scroll down, you can see the contract address. So if I copy that contract address and bring it back on over here to Jupiter and paste in that contract address, there we go. So that is the official token. I'm going to go ahead and click through to there. If I hit one Sol into Geode, it looks like a little bit of slippage, 20 basis points or so. So I would just, probably wait a little while to get a better rate because, 20 or 30 basis points of slippage, that's a lot, actually.
I actually just bought it on Coinbase because I have Coinbase One. Yeah, I didn't have any of those issues.
Right. Yeah. For me, I prefer to, self-custody everything. So, but
you can move it off there once you buy it.
Right, but Coinbase is one of these big centralized exchanges, and it's going to report everything that you do. But if I hold it in my self-custody wallet, then that responsibility falls back to me. I don't have to deal with Coinbase. So if I'm taking a look here at Geode, I want to take a look at that hardware. So how do I get some of that hardware to potentially run one of those nodes wherever I go, right? So over here on CoinMarketCap, I can click on website, and here's the website, the Global Positioning Network for the Autonomous Future. This is really, really cool. So I want to look also at the performance of the token, GEOD, USD.
Today with a BitMEX listing, and
wow,
it's had a pullback.
Yeah, so it was all the way up at 34 cents, almost 35 cents earlier in the session today. If we just zoom out here on this daily so that we get a little bit more data, I'm curious to see what this looks like. Okay, so these data go back to June of 2024. And nice move to the upside, trading above that 200-day moving average. So you can see the 200-day moving average acted as resistance for much of the last year. And then when Geode broke out above the 200-day moving average, it retested it. So you got the breakout, the retest, the push higher, big listing today. So big pump, gave back most of it. Gave back a little bit more than half of that move, but still plus 19% on the session. Looks pretty good. And I like the tech. I like the tokenomics. I like the project itself. So now I'm just curious, what does it look like to actually run this? Satellite reference stations. Okay. So, these are the vendors. Got it. So let's see here. How much these stations cost? If I want to pick one up from one of these vendors and run this thing, how much do these stations actually cost? Because this looks pretty interesting to me. GeoPulse. Oh, wow. So this is a car navigation device. GeoPulse is the world's first consumer car navigation device that is 10 times more accurate than GPS, providing 1/10 of a meter or 4-inch absolute positioning. Wow, that's pretty cool. Awesome. Buy GeoPulse.
So, like, do you earn by having that?
I don't know. I mean, I would assume so. It says local rate limited. That's weird. So your gateway to token quests. Okay, what if I just click buy? Okay, welcome to the GeoNet store, accept cookies. Okay, so yearly subscription, monthly subscription. All right. And okay, these are the devices. Got it. So that's a handheld receiver. All right. And there's a base station that is looks like the receiver for navigation and autonomy. Okay. Survey antenna. Cool. Awesome. This is a cool project, man. I like this.
Yeah.
So, I wonder, like, it said 17,000 base stations in like 140 countries.
Mhm.
That's some pretty legitimate adoption. If we take a look at the network here, let's see what it says for network. Coverage map. Wow. Okay, so it's mostly in Europe, North America, United States,
In
a
India.
lot in India.
Southeast Asia, there's a decent presence.
Yeah, and also in Australia.
Yeah.
Looks like you got something going on here in, around the coast in South America, South Africa here. So yeah,
It's accurate. I mean, that's some substantial coverage for how few stations they have deployed. So they must have a decent range on them.
I mean, this is the usage map. So
Oh yeah, South America is looking a lot more saturated than it was looking in that other screenshot.
yeah, no, definitely is. It looks like this is a pretty legit project.
Yeah.
Huh. Cool.
I
Awesome.
bought $200 worth. We'll see what happens.
Yeah, let's see this thing pump, man. Looks pretty good to me.
I'll be right back, David.
Awesome. So you know what I want to do with the last couple of minutes that we've got here? I want to bring it on back to the Intel library, and I want to take a look here at Render Network. I think that we actually did run deep dive research on Render previously. So there it is, Render. Okay, maybe not. So I want to play through this Render network research because Render is another one of these DePIN plays. Now, this is decentralized GPU compute, so decentralized inference. And it looks like I see in the chat, Dondi is saying you bridge from the Cantex wallet on Ethereum mainnet to purchase Canton, then self-custody on the CipherRock. That's how you would onboard without a centralized exchange. So yeah, that's, I was looking at using Can Core to be able to onboard into CC without using a centralized exchange and get it into a CipherRock. But it seems like you could probably use Cantex too. So let's see here. I want to play this research on Render. Oh, and let me just go ahead and restart that screen share to make sure that the audio is going to work, because sometimes that audio, for whatever reason, doesn't play when I stop and start my screen share again. So we're going to start this render research here.
Modern artificial intelligence inference models are bottlenecked by raw physical hardware capacity. The computational demands of processing generative video, 3D asset generation, and large language models are continuously maxing out centralized data centers globally. By 2026, the Render network capitalized heavily on this hardware deficit. The decentralized physical infrastructure network achieved major operational milestones, processing 24.3 million annual frames and expanding its global footprint to 5,600 active GPU nodes. This growth stems from a deliberate architectural pivot. Originally built to handle 3D rendering pipelines for software like Cinema 4D, Render upgraded its network to absorb complex enterprise AI workloads. Today, machine learning and AI inference account for 40% of the network's total processing capacity. However, this record-breaking physical utilization creates a stark economic paradox. Despite surging usage and successful technical pivots, Render's native token suffered an 85 to 90% drawdown from its peak valuation. The underlying asset crashed while the network itself scaled. This visualization plots that disconnect. On the operational side, the protocol generates an estimated $2.7 million in annual revenue from job spend. On the financial side, it commands a billion-dollar market capitalization, leaving the asset trading at a towering 400x revenue multiple. Operational success in a decentralized hardware network does not automatically translate into token value accrual. Understanding why this asset decoupled from its own network usage requires calculating the exact mathematical threshold where render shifts from structural inflation to structural scarcity. To accurately map the economic model, we first have to track how demand is physically processed. The network's expansion from legacy 3D platforms into a generalized compute cluster required an entire rewrite of its data routing logic. When a developer submits an AI or rendering job, the network doesn't send it to a single server. It fractures the workload into thousands of parallel microtasks, distributing them to idle GPUs owned by independent node operators around the world. Executing this requires near instantaneous coordination and payment. The protocol migrated its entire infrastructure to the Solana blockchain, specifically to utilize its high-speed throughput, enabling the rapid, low-cost microsettlements necessary to pay thousands of independent hardware providers simultaneously. For deep learning models, the network utilizes a technique called pipeline parallelism. By logically breaking down the training steps and assigning specific
Oh,
layers of a neural network to
you're burning through
nodes,
all the projects that I'm building. I planned on just doing two a day and building up a nice repository of projects that we could have in tow.
Oh, well. We got a couple more minutes left here on render. I figured, because it's another one of these D-pin plays, we could compare GeoNet to render. But I guess we'll have Tezos and those other handful for tomorrow.
All right.
Disparate consumer GPUs can execute tasks together as if they were a single, unified high-performance cluster. Render delegates the highly complex orchestration of this logic to specialized external compute clients. Integrations with clients like Prime Intellect manage the fault-tolerant routing required to keep these multi-node distributed training sessions running across highly volatile spot instances. This modular approach allows for rapid supply-side expansion. By integrating the decentralized GPU subnet from Salad Technologies, Render instantly onboarded an additional 60,000 consumer and commercial nodes, massively expanding its capacity for background inference tasks. The physical architecture successfully aggregates global compute demand. But for this hardware utilization to benefit the token, that physical activity must be translated into direct economic pressure. Value capture within the network relies entirely on the burn and mint equilibrium, or BME. Deployed under Governance Proposal RNP-006, this is the protocol's core economic engine. Delta S represents the net change in circulating tokens, driven by emissions and burns. Requesters pay using fiat, which is converted into render tokens and permanently burned to issue render credits. Concurrently, the protocol mints a predetermined quota of new tokens to compensate hardware operators. This dual mechanism is highly intentional. By pegging the creator's render credits directly to the US dollar, the protocol shields the end user from the extreme price volatility of cryptocurrency markets. Creators experience predictable, stable pricing for their rendering jobs. The protocol functions as an algorithmic clearinghouse. It absorbs the financial friction of market volatility, shifting the economic weight away from the consumer directly onto the token's circulating supply. Applying the 2025 and 2026 operational data to the BME variables reveals the specific mechanics driving the valuation disconnect. On the demand side, network adoption is heavily accelerating. During 2025, the volume of tokens destroyed through usage-based burns expanded by an aggressive 158% year-over-year. This chart compares user demand against supply. While the burn rate scales with usage, destroying roughly 692,000 tokens, the protocol minted approximately 6 million new tokens. This creates a rough 4-to-1 dilution ratio. Because emissions continually outpace burns, the network remains trapped in net inflation. The protocol mints roughly 500,000 tokens every month, regardless of how many jobs are submitted, acting as an immovable mathematical bottleneck, preventing the asset from achieving deflation.
Yeah, it's a
Until the
problem.
aggregate volume of global compute demand scales aggressively enough to completely overwhelm this fixed baseline, the price performance of the token will remain decoupled from the adoption of the physical network.
Right.
This inflationary structure forces a reevaluation of how investors extract value. A persistent misconception is that token holders passively receive a cut of job submission fees simply by holding the asset in a wallet. The protocol features zero passive dividend mechanisms. Every dollar of revenue generated from compute jobs is routed strictly into the BME burn engine or paid directly to the physical hardware operators executing the tasks. To capture value beyond price speculation, token holders must utilize active yield frameworks. This requires investors to treat their tokens not as passive equity, but as active capital deployed within the network ecosystem. Proposal RNP-011 provides the clearest mechanism for this. Formulated with Stability AI, it allows holders to directly stake their tokens to fund the generation of a 1 billion asset 3D training dataset. In exchange for providing this upfront capital, stakers earn a proportional share of the licensing revenues paid by enterprise AI developers accessing the library. On the supply side, RNP-015 forces node operators to lock their own tokens as operational collateral. This active economic staking qualifies them for availability rewards and guarantees hardware uptime by slashing the collateral of misbehaving nodes. Evaluating Render's financial health requires abandoning the assumption of passive rental income. The asset must be priced according to its utility as active ecosystem collateral and its mathematical relationship to the burn engine. As Render attempts to scale this demand, it faces direct competition from centralized hyperscalers like AWS, Google Cloud, and CoreWeave.
Right.
Centralized providers maintain absolute dominance in providing high bandwidth interconnects and strict reliability guarantees. Unable to match these physical interconnect speeds, Render has to compete ruthlessly on price efficiency and the mass aggregation of fragmented spot compute. The network's most critical strategy for survival is the ongoing integration of enterprise-grade H100 and H200 nodes. Supporting this tier of hardware allows Render to capture high-margin large language model inference budgets, which command significantly higher per-hour pricing than traditional graphics rendering. Securing these high-margin AI budgets is the only way to drive job submission volume toward a singular mathematical target, the deflationary crossover point. This graph projects that critical threshold. The crossover point is when the exponentially rising token burns finally intersect the flat line of fixed emissions. Bridging this 4-to-1 inflationary gap is the sole mechanism driving long-term appreciation. Crossing this line shrinks token supply, transforming usage into net structural scarcity. This impending crossover serves as the ultimate stress test for the entire decentralized physical infrastructure thesis at an enterprise scale. To survive the AI compute wars and reward token holders, Render must force its physical adoption to outpace its own structural inflation. Success is no longer measured by hardware connectivity, but by mathematically guaranteed asset scarcity.
Yeah, I don't know that Render is going to be able to do it. And when I take a look at the Render token performance, if we hop on over here to TradingView and we take a look at Render USD all time, I mean, it hasn't been horrible, especially when you compare it to like most other altcoins. And it did put in a higher high this previous bull than it did in two bulls ago. So that's a big net positive because most other altcoins just didn't do that. They put in some crazy high, bull market high back in 2021, and then a lower high in 2024 or 2025. Render actually put in a higher high, but it's trading well below its 200-day moving average. And I'm just not convinced that it's going to be able to compete with the likes of, AWS and Google and CoreWeave, et cetera. I think that those big tech companies have built out such a glut of compute that I don't see how Render is going to be able to compete with that. And, even if they are able to compete with that, like, why would that mean that token price go up if that burn mint equilibrium isn't above a 1.0? So, yeah. And then if you take a look over here at DeFi Llama data. Let's just go ahead and see if we can find for render the protocol. Let's see if we can find not the BME. I just want to see, okay, let's just click on protocol here anyway. I want to see, yes, there we go. Income statement. So, hey, render makes some money, man. So, 400K a quarter, that's not nothing. So that's a good sign. That's a good sign that the render protocol actually makes money. That's definitely a good thing.
It's
now,
been declining though.
Well, yeah, it has. And
they were making 1 million in Q3 of 2025, Q4 of 2025, like went down, and then just been declining, kind of ever since.
Yeah, you're right. Down 50%, down another 18%, down 0.17%. And this looks like Q3. It doesn't look good so far.
So that's definitely not growth.
No, it's not. So this BME, look, you've got to be incentivized to use this render network for your GPU, for your inference, for your AI compute. Why would you want to use render network when you could use AWS or Google or Azure, et cetera, or CoreWeave, or you could even use BitTensor Tau now at this point. You could use Shoots. You could use Venice if you wanted to, VVV. So render has a ton of competition in this space. And I mean, look, it's great to see that they're making money, but when I take a look at the token performance, like this is not good. So this down into the right.
You see revenues decreasing, you see token price decreasing, you see basically, adoption decreasing.
Yeah.
I don't see anything that would make me want to rush out and invest in this token.
Me neither. And if you just take a look at a couple of the competitors like Venice, right? VVV, if we take a look at this, I mean, hey, this I would prefer to hold a token that goes up. You know what I mean? Like, I don't want to hold the bag of doo-doo that goes down only. I mean, it's not like render is down only. It has had a couple of pumps over the last two bulls. That's for sure.
But we have to understand that not totally. It's not totally speculative because obviously they've made some revenues in the some decent revenues in the past. But I think that, like you said, with a lot of this, the AI launches, a lot of this, compute, that's been infrastructure that's been built out, the need for this use case is diminished a bit.
I mean, I think that the need is still there. It's just that their tokenomics look broken and there's so much competition.
But but if the need is there, then you would see continued growth and revenue generation. It seems like people are going elsewhere.
Yeah, well, I mean, it does look like people are going elsewhere. Like maybe people are going on over to subnets on BitTensor Tau. The only thing is that I'm not really seeing the value accrual to the BitTensor Tau coin. Maybe that might be an interesting piece of deep dive research because it's in the same vein as, Render and GeoNet, something like BitTensor Tau, the actual Tau coin itself.
We're really quick. It looks like, let me actually see when this was. So it looks like 4 hours ago, we had another meltdown. Let's
from what? Charles, Chucky, what's going on, Chucky?
Forgive me and indulge me a little bit here because I've never had the chance to ask you in person the actual story behind what happened with the founder.
Mike, I can hear feedback.
Ethereum, dude, and shame on
Nothing
you.
I can do about
do
it.
some basic fucking research. It's been 12 years, and I've answered the question 400 times in every goddamn interview. Imagine my life experience.
Oh, dude, this guy.
Hey, you worked at a place 12 years ago for 6 months, and books have been written about it. Can you go back to that and walk me through step by step everything that happened? You're lazy. Dude, in any basic research, it is lazy. In any basic research, there are hundreds of interviews where I've spent 30 minutes, an hour, 2 hours talking about it, going back and forth about it.
Again,
12 years, man.
I had
12 years. You want to ask me about the 12 years of how we built Cardano to a $100 billion ecosystem and solved some of the hardest problems of computer science? Or you want to talk about $100 billion of my life 12 years
what
ago?
you talking about?
I've already talked about 200 times. 300 times, Charles, 400 times. Again, if a traumatic event happens in your life and you're done talking about it, you've said what you wanted to say, it's not appropriate. Just keep badgering people after 12 years about the goddamn thing.
Oh my God. Dude. Chucky, I think he needs therapy or something, or drugs. Who knows, man? He's got to get some help, dude. Because, or maybe what he needs to do is dedicate himself to building Cardano into not a piece of shit. Like, that would be good.
Well, I mean, that's kind of, I think, what the guy interviewing him was kind of trying to get at was, okay, 12 years, and he said that a $180 billion ecosystem. It's like, what? I mean, there's no DeFi to speak of. They're trying to get stable coins on there. They were talking about that they were going to do some native Bitcoin on Cardano that, to my knowledge, never happened. I don't know of anything that of note that is going on that chain. So, and I've been saying that for years. Back when people were still bullish on it and still talking about that it was the greatest tech out there, and a lot of influencers. I've been telling people that I just don't see the there. I don't see where the token. I didn't know about I didn't think about value capture back then, but I was just looking at basic adoption, basic revenue generation. I don't see any of that. And from a business standpoint, if people aren't adopting your product, then your product sucks. It might not suck, but it's just you're not getting adoption. And with the market cap that Cardano's been at, the top 10, top 20, consistently, I just don't see the risk to reward. It's not like it's a micro cap or something like that to where you're potentially going to see a 100x or more. I mean, it's a top 10, top 20 token, or was, and it's just not getting the adoption. It's just, nobody is using it.
So, Mike, what else doesn't help? When you've got the main face for the entire project going out on some of the biggest podcasts in the space and crashing out, seemingly like on a bi-weekly basis at this point. Like,
and that's why I showed it. As a lot of people will, when they see a major pullback like they have on Cardano, they'll think, oh, this is a great token. I've heard about it. It's this is a buy opportunity, DCA, and it's. I mean, you do you. I just, me personally, I won't be buying this dip. I bought Solana on the dip, with the FTX crash, because I looked at that as, that was market manipulation in my opinion, because
you turned out to be right. You were right.
Well, and a lot of people, it's because Binance, founder, he dumped, his FTX token, it had a direct connection to, Solana, and a lot of stuff happened. It had nothing to do with Solana. So when I saw that pullback, I was like, I'm going to throw a couple $100 in and see what happens. And it paid off for me. But, again, it was a very small play. It wasn't a huge part of my portfolio. I just don't see any legs holding Cardano up, personally.
Me neither.
Tim guy, he is investing a bunch of money to try to onboard developers and dApps and stuff like that. But he's doing it because he gets basically a chunk of whatever's launched, is my understanding. Where he brings them out, houses them for like a 4-week workshop, and then for that he gets like a percentage of whatever it is that they build or something like that.
Right.
And I'm sorry, I just don't see how that's bullish for the token. I mean, it might be bullish for Cardano, but I don't see how that translates to the token because, the value capture and tokenomics still suck.
They do. The big takeaway for me, though, is you've got the founder going on podcasts often and just making a fool of himself, man. I mean, you know what he could be doing? He could go on these podcasts and he could say, hey, listen, I know that the token hasn't been performing well, but this is what we're doing to fix that. And we're building this, this, and this. And over the next 12-month period, this is what we're going to launch. Like, get people excited about something. But we see the exact opposite. And then you take a look at the token itself sitting at, 15.9 cents. And it's like, man, like you talk about, wealth destruction. That's what this is. So, that white line that I've got drawn in there at the bottom of the chart there, that is where I think you might see some support for ADA down at 2 cents. So look, just because something has drawn down, if I just go ahead and highlight that right there. So 2 cents. 2 cents is where I think there might be some support. That's from
lower highs and lower lows.
Yeah. I mean, look, like, if just because something has drawn down by 95% from its all-time high, just because something has become cheap does not make it a good buy. Especially when the founder is going out on TV every day and just, speaking like a moron. Like, come on, man. So that's not a good look. So I wish, ADA and Cardano holders the best, but it doesn't look good, man.
Yeah, unfortunately. I mean, I don't like seeing anybody lose money, but unfortunately, that's investing. So, well,
it is what it is.
Yeah. Well, we appreciate you all for popping in. If you could, please like, share, and and subscribe if you find the information that we put out here valuable. Help us grow the channel. Help us get this information out. Not a lot of channels are willing to point out I don't want to say negative because real facts, real data that prevents you from losing money is highly valuable. And not a lot of channels out there are going to tell you that because it doesn't get clicks, it doesn't get engagement. We are about good, solid information here. If we have 8,000 subscribers or 8 million subscribers, we're going to give the same content. We're going to show you the good, the bad, and the ugly on all these projects and the tokens because we want you to be educated if you decide to buy, if you decide to invest in these. We just simply want to educate you. We do not want to influence you. So, David, closing thoughts.
Yeah, if you get some value out of what it is that we do, like, share, subscribe on YouTube, hop on over to the node.pro, jump into the community, and post some of the deep dive research content so that we can have a discussion about it, or jump into the DeFi University there and build a skill set for yourself. And if you want to work with me one-on-one, hop into the coaching tab, schedule 30 minutes in my calendar. I'd love to talk to you.
Awesome. Well, appreciate you all in the chat. Until next time, Veteran Crypto out.
Peace.